The segment of Heads or Tails with Michael Rudolph. I'm Bill Priestley. Thanks so much for joining us here. And Michael, we had Grace Sharkey on earlier today talking about some of the retail trends that we're seeing. You want to get into some credit cards and some inflation here as well.
That's correct. And so this is another kind of victim of this segment being an early on Monday morning, right? Get kind of new data that changes the whole theme of the show. Initially, I was going to be talking about the kind of consumer credit reports that the Federal Reserve releases on a monthly basis. And there, at least, we saw some kind of promising starts to consumers dialing back their spending. It's been kind of up and down for a while now, but in September, the revolving credit decreased from an annualized rate of 13.7% to an annualized rate of 2.9%, right? Revolving credit is, of course, stuff like credit card debt, where you just kind of keep the till churning there. So we did, see a kind of slowdown in that. That was nice. This is, again, looking at September, right? We're now at the end of November. We just had Black Friday. We're having Cyber Monday, if people are still interested in that. And it turns out that it looks like, yes, people are. We just had a new report from, I think, Adobe Analytics released today. And I think retailers were kind of going into Black Friday a little bit gloomy and uncertain. You had people like Best Buy say, look, we're going to revise our fourth quarter earnings forecast to be safe. We're going to revise it down. But the consumer is so unpredictable right now. There's really no telling what they'll do. And this kind of sentiment has been echoed across multiple different retailers for multiple months now. And, sure enough, you kind of go into Black Friday thinking, okay, it's not going to be as big as last year. And then you get this new, fresh data that says, oh, spending was up, 7.5% over the weekend. There's a caveat there, right? We did see a kind of slowdown in the revolving credit that's reported by the Fed, right? This tracks credit cards. We don't really know what's going on with buy now, pay later programs, right? This is the kind of Klarna, Afterpay, what have you. It's still a bit of a
this was the worry at the same time too, that people weren't necessarily going to go buy now, pay later. That was going to be the bridge that may be going too far, and some people might say.
I actually was hoping that there would be a kind of slowdown in adoption of those programs, because I think the market was getting too oversaturated from them, and then consumers are kind of starting to cotton on to the idea that, look, this isn't, if a deal seems too good to be true, it probably is. What we're seeing right now, at least in terms of the data that's released by Adobe, for one, is that buy now, pay later options jumped 72% compared to the week before Thanksgiving in the Black Friday week. 72% is quite a lot. Of course, it's to be expected that they would, kind of use those programs one week and not the next. But I think overall, we're seeing a 17% year-over-year increase during this whole holiday season. So that's not good. I mean, interest rates are extraordinarily high if you miss a payment in those programs compared to a credit card, which are still astronomically high. So the credit situation is not looking too hot for the moment. I was kind of prepared for a consumer slowdown in spending, which would be good to the long-term stability of truckload markets.
And as you mentioned, the data doesn't necessarily, we haven't gotten it yet, but it looks like at least a slight slowdown as far as this charge is concerned, but we haven't seen, obviously, November yet.
Right, we haven't seen November yet. We have to see October first.
Sure, yeah.
I'll mention really briefly that green line on there, that's non-revolving. So that's your kind of stable debt, mortgages, student loans, stuff like that, the kind of stuff that you pay off every month. That did kind of tick up a little bit in September, not too much, but you can see there's a brief dip there kind of in the middle of the year, but it's starting to kind of tick up a little bit. That is not supposed to move very dramatically because of higher interest rates in the months going forward. So we'll keep an eye on that, but that's not the exciting part. The white line is the real excitement.
Gotcha.
Touch very briefly on this, it's the federal funds rate. We just saw the Federal Reserve meet a couple of weeks ago, and we had their minutes released, I think, the week before last. It looks like this is going to be the peak of the rate cycle this go around, right? We have data kind of stretching back to, the late 90s, early 2000s. This is going to hurt. This is already hurting some people more than others. But the fact that this is kind of the peak, at least it's expected to be, that's good news for the consumer if they can kind of curb their own spending. That would help bring down inflation. Already we're seeing some long-term movements in the bond markets, right? That's already kind of fighting inflation on behalf of the Fed's intervention. So We hope to see these rates come down, I think, maybe late Q2, early Q3 of next year. And the timing of that is going to be very precise.
So when you look at this, obviously, are we at the top of the mountain here, or are we're just kind of, is it going to plateau? Just put it that way, just stay.
That's true. I mean, it's going to plateau. I think that's beyond question. It's going to plateau for several months. Question is how many specifically. I think according to the recently released kind of minutes of the last meeting that the FOMC had, they said that market participants, kind of traders, analysts, scheduled in a probably, it was like an overwhelming likelihood that it would start to begin in late Q2 or early Q3 of next year. And that's when it's going to be a very slow kind of decrease, right? You see the rapid increase in rates. It's not going to be like that on the reverse. It's going to be very slow and steady. It'll probably take years to come down.
Which is interesting when you look at it historically, because you see kind of a gradual up, and then a stark dropping back down here afterwards. We could see the opposite here.
Well, yeah, I mean, that's a good point. The caveat is it will be a slow drip feed down if the Fed can nail the soft landing, right? If not, they're going to pull the emergency lever, the parachute, and just try and get us out of this mess as quickly as possible if we do find ourselves in a recession. So then, yes, I mean, it will be like every other cycle. You'll see the sharp drop. So we'll wait on what to see, but for now, it's still looking fairly soft.
We've got about 20 seconds left here. So what are we looking at in terms of heads or tails? Are we at headwinds or tailwinds right now? It looks pretty obvious here, though.
Yeah, I mean, it looks like a headwind for the near future. So unfortunately, I was hoping to have some bit of good news, but not going to be this week.
Unfortunately, there. So Michael, thanks so much for joining us for this week's version of Heads or Tails. We'll see you next Monday.
Thank you.
All right, we'll take a short break. Come back with more for It Was Now after this.